Good day. In this video, we're going to have a look at the deduction of retirement fund contributions in the calculation of taxable income. I just want to remind you, like I said to you in an earlier video, that every time we look at something in this module, we need to make sure that we contextualize it within the framework for taxable income. So I just want to remind you that we are at the point here where you will have calculated all the gross income, you would have done the other deductions for exempt income, the deductions for Section 11, the taxable portion of allowances, and you would have also done the capital gains tax calculation and included the 40% in taxable income. And so we get to the point where we need to look at whether the taxpayer has contributed to any retirement funds and to see how much they can deduct to get to their ultimate taxable income for the year of assessment. Now remember, the bigger the deduction, the less the taxable income and the less the tax payable. So from March 2016, all of these contributions to retirement funds have been dealt with in terms of one limitation. So if you have dealt with tax from before then, you will know that in the past, pension funds and retirement annuity funds were dealt with different limitations, and provident funds were not deductible. But since March 2016, it's been streamlined. And so what you need to do in a question is to add together all the current contributions, so the contributions made in the current year of assessment by the taxpayer to pension funds, provident funds, and retirement annuity funds. To that, you need to add the contributions that are made by the employer to a pension or provident fund, because as you'll know from Learning Unit 3, these contributions are a fringe benefit and have been taxed in terms of gross income. They've been included in the taxable income. So now the taxpayer is entitled to add those contributions to see how much of them they can deduct as this deduction from taxable income. And then also you can add any unclaimed balance that was on hand or was available, not deducted in the previous year of assessment. This changes in the year of retirement, and we'll look at that when we do lump sums. But in terms of, for now, any unclaimed balance at the end of the last tax year will also be added to the current contributions. And we'll get a total then of all the contributions made by the taxpayer and the employer. So the contributions that have been added up from the taxpayer's contributions, the employer, and any unclaimed balance from the previous year, that total is then limited to the lesser, so the lower, of 3 limitations. Now, when the retirement fund contributions were aligned and the Act was amended, it was agreed, well, the amendment to the Act said that there would be no more than 350,000 Rand being deducted for this contribution. So that's the maximum that a taxpayer will get. If the other amounts end up being bigger in terms of this limitation calculation, the lesser will be 350, and therefore the maximum that the taxpayer can deduct. So that's an amount from stipulated in the Act. Secondly, the second part of the limitation is the percentage limit, and we'll have a look at that. And then thirdly, and this is what a lot of students forget to include in their limitation calculation, because it came in later, and if you're using an old textbook, it won't be in that textbook, but the taxable income before any capital gains tax, and also excluding. So it excludes capital gains tax and excludes lump sums. Okay, so the person can deduct of their total contributions the lesser of these 3 limitations. The percentage limit also needs to be calculated, and that's based on the higher of remuneration or taxable income. What you need to note is that the taxable income in the 3 of the lesser limitations is before capital gains tax and excluding lump sums. And then when you're doing the 27.5% or the percentage limit, you need to look at taxable income including capital gains tax but excluding any lump sum. Okay, so we are going to work through an example this so that you can see the application of it, because I do find that students do get muddled up and you need to do it just in the order and then compare the amounts. What you do need to remember when you're doing an example is, first of all, you need to show all the contributions and to get a total. So you need to show us the employer's contributions, the employee's contributions, whether it's to a provident fund, a pension fund, a retirement annuity fund, and to give us the total of the contributions that the taxpayer can deduct for the year. Then you need to calculate the limitation that I've just been through, but showing all your calculations. So how did you get to remuneration? What taxable income did you use? You can't just put down the words. I need to know when I'm looking at your answer, or we need to know when we're marking it, that you know how to apply the limitation. So you need to apply those terms, taxable income, remuneration, and you need to show us all your calculations. And then you need to make a decision on what the limitation is going to be. A lot of students just merely add up the total, put the 3 limitations down and then say deduct this amount. So you need to say, well, here's the contributions and it's going to be subject to this limitation by applying the lesser of those 3 requirements for the deduction. And then you compare the limitation with the contribution. And then you'll either be able to deduct the contribution in full if it's less than the limitation, or the contribution will be limited to the limitation and you can deduct it from taxable income. And then if applicable, so if the contributions have been limited in terms of this limitation, you need to show the amount that will be carried forward to the next year of assessment. Okay, so that's going through the theory of it. In the next video, we'll have a look at how we can apply this limitation to information that's given to us in a question.